Good afternoon. My name is David Auerbach. I'm the Chief Investment Officer of Hoya Capital. Excited to be joined by Shawn Tibbetts, the CEO of AH Realty Trust, formerly known as Armada Hoffler. And we're going to go through a couple of slides here on the screen to start out. I'm going to turn off the presentation. We'll have a conversation. We'll refer back to the slides as necessary. So, Shawn, if there's a particular slide or two that you want to hit, we'll mark it and we'll come back to it. But good old Wall Street, every firm has the little compliance disclaimers disclosure. So we're going to share their forward-looking statement disclosure that they've asked us to share here for a couple of seconds. We will leave that on the screen to satisfy the compliance requirement. For those that don't know, as I mentioned, our AHRT, formerly known as Armada Hoffler, founded in 1979. They did rebrand earlier this year to align the brand with a renewed strategic focus on discipline, growth, and operational excellence. And I look forward to going into what that means exactly. Office retail exposure in the Sunbelt, Mid-Atlantic, and Southeast. The mission. And by the way, all of this information that you're seeing on the screen comes directly from the company, either in their first quarter earnings supplement, their investor presentation, or other presentations that are on their website. But this is all straight from AH Realty's website. But the mission is to create long-term shareholder value through execution, capital allocation, and managing a high-quality portfolio with integrity and focus. Through the vision of maintaining a high-quality portfolio that delivers benefits for shareholders and supports the growth of thriving communities. Our speaker, wearing glasses versus on the picture here, long-time leadership experience, long-time executive. And how many years have you been there now, Shawn? Seems like it's been a long time.
Yeah, almost seven. Came in August of 2019.
Gosh, it feels just like yesterday that
Just
we
in time
met.
for COVID, David. Just in time for COVID.
This is some first quarter earnings highlights. FFO 15 cents a share, adjusted 19. We bought 3.7 million shares. Retail same store NOI up 2.2%, office up 0.7. And it's interesting here. We talk about what they started in February with this rebranding concept. They did do a massive multifamily portfolio disposition. They also just recently, in the past several weeks, divested their construction and real estate financing business. But this new AH Realty Trust is basically Armada 2.0 post restructuring of the business. We talk about some of the milestones. My longtime colleague Ted Bigman going on the board. Former colleague of mine, Dennis Scartman, will be retiring. As we mentioned, the multifamily portfolio disposition, the construction business disposition, very active buying back stock. And, it's really interesting here because in part of their earnings, they put out a great slide going through their 2026 revised outlook. And this is pretty broken down. I got to give them credit compared to a lot of the other REITs where they really go in on a line by line basis here to kind of tell you where their thoughts are at. This looks at some of their NOI trends over the past few years and where things are going, let's say, post transformation. And then we look at the portfolio profile. We'll get into the lease expirations. There's a slide that we have coming up here that talks about that, as well as the weighted average lease term. But I think one thing to note here is looking at the new lease cash spreads, lower right corner here, and how things are on a positive. As we mentioned, they are office and retail. So we take a look at the slice of the pie of retail. Community center, lifestyle center represent more than half the portfolio, 4 million square feet, 48 retail properties, 15 office, 2.4 million square feet, most of it as a mixed use. For those that follow it, when you think of AH, the first thing you think of is T Row, Baltimore. At least that's what I think of, and what's going on out east. We talk about their debt profile, the leverage, how the debt maturity schedule looks here. And I think this is a very important slide looking at tenant makeup. I always talk about this with every single company, and I know we're going to get into it, but we look at the tenant makeup, as I mentioned, T row here. But Constellation Energy would be the largest tenant on annualized base rent at 11%. And a very interesting mix. Honestly, some companies I've heard of before, some companies I haven't, and I'm sure we can go into that. As I mentioned, the lease expiration schedule is very, very important because this kind of guides future growth. Knowing management teams, they're always focusing on what's coming due. Frankly, you know, I don't know how else to say this. Yeah, we got to worry about what's going on in 26. But if I know Shawn and the team, they're already thinking about what's coming up in 27 and 28. And I'm sure already having some conversations with those tenants. This is a very important slide as well, especially the bottom part. And I do have a question teed up for you on the opportunities for redevelopment. Again, kudos to the team for talking about where they see opportunities lying in the portfolio. And it seems like the redevelopment is the major opportunity here. So, with that, and Shawn, obviously, if there's something that jumped out at you in the slides that we put together here, we're happy to talk about that. But let's jump into it. We've talked about the strategic transformation. For us as shareholders, what do you think is the most meaningful inflection point of the company this year? Is it selling off that multifamily portfolio? Is it getting rid of some of this ancillary business lines? What should we be focused on going forward for the rest of the year?
Sure. And thank you for the question, David. I think, the answer to that question is complex. And the reality is, at a high level, we are intending to reduce complexity, right? So you've seen quite a bit of activity in the quarter. Candidly, you've seen quite a bit of activity in recent history here at AH Realty Trust. To your point, we're a company in transition. And so I would say it's a combination of things that are most meaningful. I would say the progress on the transition as a whole has been significant, right? I mean, you mentioned it a second ago. We announced for first quarter guidance back in February a $562 million sale that we had come under contract with Harbor Group. And for us, that's a big deal. We'll be selling 11 out of our 14 assets. We're a few weeks from closing out, couple weeks, as I said on the call, from closing out on that or closing the majority of those deals, and you'll see that transaction wrap up likely by the end of the year and catch kind of the tail of the last asset or two. We went to market with two of the remaining multifamily assets, so those will also are slated to sell this year. We disposed and exited of three of our four real estate financing investments, if you will. Exited the general contracting business, as you mentioned, and repurchased 4.3 million shares as of last week of our own stock. And my message to the market, as you heard, was, look, we thought it was very attractive to invest in our own assets at above a 9 cap. And we believe in that, and we believe in the company, and therefore we use the proceeds available to us while maintaining the future leverage that we told the street we would maintain between 5.5 and 6.5 times, and bought back shares. And I think that's great. We beat and raised in the quarter, in the first quarter, and we nominated, as you mentioned, two highly skilled independent directors who are going to help us guide kind of the next chapter of this journey. So I would say it's hard to call one of them. We're excited about all of them, but we're excited mostly about the momentum that we're creating here at the company, and couldn't be more excited to talk to you today about it.
Obviously, there's a lot that you can't say, so I want to be careful as I ask this question. But in terms of trying to simplify, at this point, you're still a diversified REIT. I mean, when you're talking office and office and retail, that's two completely different sectors, two completely different focuses, metrics, everything. I know it's hard to look at the crystal ball and look ahead, but is there a chance that one day this is a pure play of either just pure play office and you spin off retail to its own thing, or pure play retail and you get rid of office? There's only, frankly, less than five of your peers that I can think of off the top of my head that have that dual sector approach like you do. And I feel like REIT Industry 2026 wants a simpler story and not a company that's across multiple sectors. What's your thought there?
Yeah, I think generally I would agree, David. As I think about our business post kind of transformation commencement, we had essentially five different businesses, right? We had a multifamily business, an office business, retail business, general contracting business, real estate financing business, and add to that, we had derivatives fixing the rate on the debt that we had, right? And so I think you bring a good point. I say all the time, complexity, essentially breeds confusion. Actually, Dennis Gartman says this to the name you mentioned before, and simplicity essentially breeds success. And you see us simplifying this story. We've taken a big chunk out of it. Yeah, I think there could be a case where we at the right time, in the right market conditions, David, take this to a even more simple model. But today, I don't think is that day. I think there's an opportunity for us, as you'll hear me say later, to create additional recognition of the value that's underlying the portfolio. Maybe said another way, I get the question a lot. Why don't you just sell office? And the challenge with that in our story is number one, our office is not suburban office. It's got a very high credit tenant profile, right? And also 95% of it sits in a mixed use ecosystem. So I don't think that just selling the office just to simplify makes sense. If the economics work and the market believes in a pure play story, i.e., one asset class or another, and there's value there, we'll take a look at it, but not at all cost, right? And I think the timing has to be right. It doesn't make sense to sell some of this high quality office that we have today into this market. That being said, if it's possible and it's good for shareholders, we will take a look at it. And as demonstrated by our actions over the past months and year or so, we will do what's necessary to create the value there. So, at a macro level, yeah, I agree with you. But I would say this to you: it takes a while. Real estate's a longer term game, and we are simplifying the story in a drastic way, all in one shot this year. And we will continue to move that needle to the extent that it makes sense for the shareholders. We don't want it to be punitive. We want it to be accretive. And if there's an opportunity to do that, we will. Otherwise, we'll continue to operate this portfolio and create value in the platform that we own here. And I think, I can't say it enough. We talk about our portfolio as high quality retail and mixed use office because, again, 95% of that office sits in one of these ecosystems we built here in Virginia Beach or down in Roswell, Georgia, or to your point, up in Baltimore, where this ecosystem works together and this kind of, rising tide lifts all boat concept takes place.
And frankly, we're sitting at a time right now that M&A, I feel like, has been more prevalent right now than it ever has been in our sector, especially if you're a small to mid cap REIT right now with high quality assets that you're talking about. It seems like that's highly, highly in demand. Obviously, some sectors as a whole are much more in demand than others. Obviously, we haven't seen any real office mergers recently. A lot of it's been happening on the industrial side or on the healthcare, senior housing side of the equation. But I feel like it's just a matter of time until we start seeing that creep into other sectors. And thus, you know, he who has the high quality portfolio is going to be the one that's in demand. So it seems like, I'm not saying that you're putting yourself in play here. I don't want to come across that way. But a lot of the moves that you're talking about here simplify the story and thus make it easier for a potential investor to look at this and be like, oh, okay, I get the story. I see what they're doing. We like this. You've talked about the board refreshment. Please say hello to Ted the next time that you catch up with him. But how do you feel? Ted's, for those that don't know, Ted is part of the original REIT mafia. I mean, that's basically how you phrase what Ted is. He is a very well-respected REIT leader. How does this refreshment strengthen your governance framework for the right oversight, expertise, and independence? How do you have these people come in and be independent? A guy like Ted, who knows a lot of these management teams, knows a lot of these companies, is sitting on other boards involved in other things. Again, like how do you make sure that they're coming in with the right mindset here?
Yeah, I think, look, we went through in a process that we run here for board refreshment. And our view is we're a company in transition. We're not the company, exactly the company that we were, and we need new skill sets and enhanced skill sets specifically related to REIT, public markets, capital markets, REIT, C-level executive experience, as well as investor perspective that Ted brings, obviously, um, to our board, because I think, this is a different story than it was. And we would like to get enhanced, and we will continue to get enhanced kind of guidance from folks who can give us maybe a different vantage point and a better way to look at this and continue to enhance our company. In terms of the process, we actually didn't know Ted, which was interesting. And so it was great to meet him. And it was great that the opportunity was there for him to be available to come on the board as we were looking for refreshment. And the same is true for Lori. She has deep experience, been a CFO of a public REIT. She's the chair of a public REIT, right? And she's got deep experience in the REIT and capital market space. And as you think about where we came from, this company that essentially developed and constructed its own portfolio, and you think about where we're headed, capital markets focus, how do we get additional long capital into the stock? How do we get this reset story better heard on the street, better understood? We thought, okay, these people match what we need in terms of enhancing the skill sets on the board. Can't be thankful enough for Governor Allen and Dennis Gartman for their service here on the board. But also at the same time, like I said, things change. Here I am, right? The former administration isn't here anymore either. And we continue to evolve and continue to enhance the company. So I think that's a long way of me saying, look, we're super excited and fortunate to be able to bring that type of skill onto our board, and we'll continue to look for ways to supplement and enhance the board in terms of the skill set and the perspective that we see there. Look, we have a strong governance kind of culture here, and the question you had about how do we ensure, we interviewed them in a very deep way on multiple levels. Obviously, we have the standard D&O questionnaires and the standard D&O kind of conversations about these folks, but also we dug in. How do you feel, potential candidate? How do we feel about the match? How do we feel about your experience? What other obligations do you have, so on and so forth. And we wanted to ensure that, to your point, these folks bring an independent perspective and candidly are representing the shareholder base in a way that benefits us all, mainly the shareholders, right?
The multifamily disposition was probably one of the bigger levers that I've seen you guys pull over the past several years. I mean, it wasn't a one-off. I mean, yes, it was a one-off, but it was a massive price tag on that. So, one, how does that support the long-term transformation? I know, again, it talks about simplifying the story. Proceeds, was that used to buy back stock? Is it still sitting in the bank once the deal closes? I know you're mentioning it's still in the process of closing, but like, how do you earmark that type of capital that's being raised, and what do you choose to do with it?
Yeah, that's a great question. To back way up, talking to our investors consistently, I heard a couple of things. One was we really like the company and we like you folks, but we think that your leverage is too high. And check, right? Okay, I got it. Noted. And we also heard, look, some of this fee business we're not wild about. This is confusing. It's difficult to underwrite. You alluded to this a few minutes ago, David. And so as we thought about the business on a go-forward basis, we're a company with embedded value, right? That we needed to unlock for the benefit of the shareholder. And we thought about every mix, right? Do we sell this? Do we sell that? Do we sell retail? Do we sell retail and office? Do we sell office and retail? And it really comes down to the objective was simplification, reduce leverage, right? And also enhance what I was calling the quality of the income stream, meaning repeatable property level rents, NOI, income streams that the market is valuing with the appropriate multiple. So when I looked at us, we had real estate financing, right? It was throwing off 20 cents of earnings or whatnot in 2024, in 2025. And we had a general contracting business that, again, built a lot of this. But the reality is, a lot of investors were not giving value for that. And I get it. You said it a minute ago. We're in a pure play REIT environment. And to the extent that we had these ancillary businesses throwing off fee income, it detracts from the story, right? And it actually is dilutive to the focus on the actual assets that are underlying the portfolio. And if you think about it, where we landed was, okay, number one, where can we unlock the most value? Stocks trading at a 9 cap. I have assets that I was able to sell at on Main Street, if you will, to the private market at a mid 5 cap on in place. I've got this fee income, right? And we have an opportunity to pay down debt by unlocking that arbitrage and essentially take away some of the subordination for the shareholders, right? So we landed on the best option was, although we think the multifamily business generally is great, the biggest kind of shot in the arm, right, for our company was unlocking that arbitrage and paying down the debt with it, essentially, with most of it. And I'll answer that question in more detail in a second. I think it's important, though, that we add to that. We had about 3,500 apartment units, great apartments. We loved them. I hope Harbor Group loves them, and I'm sure they will, right? They're excited about it. We're excited about it. The challenge I think that people miss is that we're actually best at running commercial properties. If you look at the numbers, if you look at our properties, we add best value in the retail and office space. So if you package all those variables up, made a lot of sense to us to say, okay, let's part ways with this multifamily. Let's unlock the value. Let's pay down some debt and let's simplify the story all at the same time. At the same time, let's exit these fee businesses and get the investors focused back on the underlying retail open air centers and this mixed use office portfolio that we have. And I think, David, that's a long way of saying we did a lot of work to determine what was the best path forward. Obviously, we had some good ideas about how this would look, but our intent is we're going to bring in around $750 million worth of proceeds all in once this transition happens, once we close on all these deals. And about 700 million of that will go to pay down debt. And that's big for us. We're going to go from, you just had the charts from depending on what time frame you're looking at. We're going to go from, depending on which number you're looking at, but 8 and some change leverage to a range of about 5.5 to 6.5 times is what we've committed to the street. And for us, that downturn of 2 turns of leverage is huge, right? And in addition to that, we had modeled $50 million for share repurchases to protect tax liability at the REIT level. Given the allocations on the purchase price on the Harbor Group sale, we believe there's not a significant or material tax obligation to the REIT. So we took that capital, which we consider to be fungible, and we said, okay, instead of buying a retail asset at 6.5 or 7 cap, we'll buy our own stock at north of a 9 cap. And so what you see us doing and committing to the market is we bought back about $24 million worth of that 50, about half of it already prior to the earnings call. And we said we're going to take a look at where the market sits, what the share price looks like, and we're going to be judicial in our capital allocation scheme. And we may buy back more shares, which is given where we're trading, an attractive option, right? So I think long story short, we paid down a ton of debt and we're also retiring some of the common equity at the same time, which I think you would agree is beneficial to shareholders broadly.
I want to tap a little bit more into that because as I hear you talking about this, I think about JV partnerships, institutional capital, sovereign wealth fund capital. You know who the players are that are sitting on the sidelines that are looking for high quality office trading at deep discounts to NAV. Let's just put it that way. And so I'm curious, again, I know there's only so much you can tell us, but how much is your phone ringing off the hook with some of these players that want to sit down and have a conversation with you about potentially a portfolio transaction, selling a stake in, high quality asset, something like, are you seeing more and more creative capital ideas coming inbound because of where we sit today versus where we were 6 months ago or a year ago?
Yeah, I would say generally yes, right? To your point, David, there's a lot of capital out there. And, whether it's a pipe or a JV or you name it, there's a lot of creativity in my mind out there talking about ways to structure deals, right? Um, I think I think that has a lot to do with the macro environment, right? And the way that REITs are trading broadly, number one. And number two, in our case, we reset the company. So we drew a lot of attention, which I don't think is a bad thing, right? I want people to pay attention to our story. As you and I have discussed before, and you actually mentioned it, thank you. We are as transparent as we can be with our disclosures, with everything that we share, because we want people to understand the story, right? We're headed towards simplicity because we want people to better understand this. I think the reality is there's a lot of capital out there. There are a lot of opportunities. I think our duty is in the current chapter to close the gap to what we believe NAV is because that capital that's sitting on the sideline is not cheap either, right? And I hear about pipes and JVs, and I think they're great when appropriately done. The challenge becomes what next? What happens then, right? Because they obviously have a cost of capital as well. So our view is we want to give more of the value back to the shareholder by closing the NAV gap, by continuously telling our story, getting people to understand what assets we own, and then we'll say, okay, does the market like that or not? And then I think there are options to your point. Do we look at some and you see other REITs doing it, right? Do we look at some JV structure, or do we move closer to a one asset class REIT? And I think the question will be, how does the market respond to the closure of this chapter, which is the transition chapter that we're in today? But broadly, yeah, I think there's a lot of capital and a lot of interest in assets like ours. The question becomes at what price and what timing and what really makes the most sense for shareholders.
The reason I asked that question, we've seen a couple of triggers recently. You look at like what Maywin Capital has done with both Chiron and FrontView, a unique convertible preferred equity offering. You have the mindset of a family office is different than the mindset of a Nuveen, which is different than the mindset of a government of Singapore, if that makes sense.
Yep.
Obviously big, 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 big buckets of money, but investment time horizons differ across those three different types of investors. And that's why I'm thinking about, who that right player could be that's like, we got you. We're there for you. We love what you're doing. You want to go out and buy Bank of America Plaza in Dallas, Texas? That's great. We're right there to give you that 70% that you need. Go. So that's why I'm curious about how that um, conversation is changing because I feel like again we're not seeing these high quality assets trading at deep discounts. That gap is closing. I feel like by the day, and look at REIT performance recently that kind of backs that up. We're finally been able to turn that page. Sentiment is finally improving in our sector. Obviously, the 10-year isn't playing to our strengths right now as it was a couple of weeks ago, but we're starting to see that. All right, so then let's change a little bit. We'll get our little crystal ball. How would you feel the geographic slash sector approach or pie looks like 5 to 10 years down the road? It's not like you're going to wake up tomorrow, as we were joking before, and you're going to be a Bitcoin miner. It's not like you're suddenly going to go out and buy Summerlin from Howard Hughes in Las Vegas tomorrow, unless there's something that I don't know. So do you think that a lot of it changes 5 to 10 years down the road, or slow and steady wins the race? Keep doing what you're doing so well.
Yeah, I think, look, we've narrowed our focus to this open air retail world that we played in for a long time, and the mixed use um, ecosystem setting that we've created for a few decades now, right? And I think to me it comes back to fundamentals, David. At the end of the day, I don't think we're strictly bound, by the states that touch the Atlantic Ocean, right? Like that. I don't think that's a strict boundary for us. I think what we're looking for is, do the fundamentals make sense to us? Right? And can we identify and capture an asset with a moat around it in a market that we know how to play in? And that's typically a secondary market, right? Like here in Virginia Beach. And so there are markets outside of our current footprint, which for those who may not know us well, is primarily Maryland down through Georgia. We have an asset or two in Florida. We have a couple of assets outside of that footprint, but 95% of our assets are located Maryland, Virginia, North Carolina, South Carolina, Georgia. And I think, you can easily identify other states, if you will, and other submarkets with similar fundamentals. And so I don't think we're bound here, especially as it becomes more difficult and yet also difficult to underwrite and make a reality a development project. I think there are opportunities out there in other markets where fundamentals align with our expertise and our kind of sharpshooter perspective in terms of being able to identify and isolate opportunities that maybe others are overlooking. So yeah, a long way of saying I think we can step outside. Do we need to? No, but I think there are opportunities that exist outside the footprint, and we may very well pursue them if they make sense for the shareholder base.
How does your office portfolio differ the most from its peers? I know we keep talking about mixed use office, but for somebody who doesn't understand what a lot of that means, can you maybe break that out a little bit?
Sure. I think, well, to your point, 95% of our office sits in a mixed use ecosystem that we control. And it's interesting because in a tier one city, I'll sit with an investor and talk about office that sits on top of retail, next to multifamily, on top of retail in this ecosystem. And, we're sitting in Manhattan and they're saying, yeah, did he not walk down the street? The reality is we play in markets where that doesn't exist, right? And the office competition is primarily suburban, and we're able to create a kind of a curated, amenitized downtown, if you will, where one doesn't otherwise exist. I'm looking out the window here at Town Center, Virginia Beach. We built and developed this over the course of 20 years, and this is a vibrant district within Virginia Beach where, candidly, I'm standing in this office that we just moved to a week ago because we continue to run out of space to lease the office product. So we relocated ourselves to a formerly empty for about 5 or 6 years retail space that was less desirable. And the reason is because the employers here can more easily invite their employees to work in a situation where there's a Ruth's Chris across the street. You can walk downstairs, get a coffee. You can shop at Lululemon, get your haircut, whatever the case may be. Those types of environments don't really exist in these second tier markets where we create the mixed use environments. And the point is, this ecosystem works together, right? There are amenities for the office folks. The office folks can live in the apartments. They can shop downstairs, dine downstairs, and it's an ecosystem that works together, especially in times of market turmoil, to keep rents elevated because of the amenities that are available to not only the tenants here in terms of the commercial space, but also the residential tenants.
So I believe we call that live, work, play.
Yes, sir.
And so that means that there's a grocery store that's probably near there, a gas station that your resident can live, work, play, have a 24/7 lifestyle like what you would see again in a New York City or some of these other markets. So how do you think that creates long-term value? Does that create a sticky tenant because of all of the amenities and offerings that are being provided to that worker slash tenant of that property, the person to live there? What's the bigger picture here?
Yeah, I think to your point, the stickiness is attractive to us. people don't want to live in a hollowed out CBD in one of these cities that,
Like Dallas.
well, the compete great city, but the city we compete with here locally in Virginia Beach, for instance, is Norfolk, and we've been able to attract some great tenants here. One that I like to use often is KPMG. We attracted them to Town Center, and that's been a great credit tenant. One and two, great kind of pickup for other people saying, "Wow, they moved to Virginia Beach Town Center. What is that about?" And I think to your point, over the long run, a place where people can live their lives, not just professionally, but personally, without really having to leave the complex. In an environment where you otherwise drive to the grocery store, drive to the office, drive home, a commuter market, if you will. I think this is very attractive, as evidenced by the occupancy and the lack of vacancy, quite frankly, that we've seen here over the past few years in Town Center, Virginia Beach, as well as Baltimore. Similar concept.
Got me going back to my days. Spent a couple of shows at Virginia Beach Amphitheater. Fish put on
Okay.
some good shows there back in the 90s. So it's been about 30 years since I've been to Virginia Beach, and all I've heard is that it looks nothing like what you remember from back in the day. So hearing you say that gets me really excited to see how that's changed. All right. One of the slides I briefly touched upon was redevelopment, and that's where you see a lot of opportunity. And I kind of put this blunt to your team when I asked the question, and I'm sure you've talked about it, but of all those redevelopment opportunities that are out there, first one, what's the most compelling one to you? And more importantly, how much do you see those redevelopment opportunities potentially adding to FFO and or the dividend?
Yeah, fair question. So I think, look, the reason that the redevelopment opportunities are attractive to us is because on a relative basis, the capital outlay is um is less than it would be if we were to otherwise purchase an asset, right? So we already own the dirt. I mean, we think about this, the best way that we describe this is we either redevelop or reposition real estate that we already own. And a great example of that is here in Virginia Beach. We had a Bed Bath & Beyond store, and over the course of about a year and a half, we repositioned it and re-tenanted the box and put Trader Joe's and Golf Galaxy in it. And we're able to, over the previous tenant, move the rents up over 50%. And for us, by the way, that sits in the mixed use development. So here you have Trader Joe's, Golf Galaxy in the mixed use development here in Town Center, Virginia Beach. And so our view is, especially when our stock is trading like it is today and a cost of capital for everyone is relatively elevated, we can be a little more surgical with assets that maybe are underutilized or dirt or real estate that we already own, think out parcels, those types of things, that allow us to move the needle. And for us, given the size of our company, it doesn't take a ton to move the needle, first of all. Second of all, in addition to that, we think that when that is added to the organic growth that we expect the portfolio to produce, that we are able to tell a very good story about the future of this company, right? And so I think, look, if I think about the dividend and the income today and the growth, I'm excited about the organic growth that exists, notwithstanding any actions that we take on redevelopment or repositioning. So for us, that's additive, and that is what we think is competitive about this company, that we have some underutilized assets that we can put some capital in and really enhance the return in terms of what we're able to see relative to our cost of capital today. And when you compare that, for instance, to buying an asset, it makes a lot more sense to redevelop in the short run as we continue to close the gap to NAV.
Kind of a two-part question. Again, we were talking about how unique you are. So without really talking about peers, who do you consider in your peer set? But part two of that is, what would you say is the upside versus that peer set?
Yeah, it's interesting. We used to be compared to JGB Smith,
Hmm.
American
Okay.
Asset Trust at times, but David, there wasn't a perfect, and that's part of the challenge, right? You're running this business, and people are having trouble first understanding it, and secondarily, how do you market against a peer, right? A true peer. I think now as we move into this more purified kind of operating mode, you have a lot. It's a lot easier to create either a synthetic peer set or one that exists out there. I mean, candidly, we think that the federal folks do a wonderful job. We think they do a great job at what they do. We like what they do. We think we have some similarities. But I think, look, at the end of the day, we are still a small firm and we're agile. And as I described, we can move, and we just did make some large scale movements in order to enhance benefit to the shareholder, right? So I think what we have is what I said earlier. We have an opportunity to close probably a larger gap to NAV than we would like. And we have some organic opportunities within the portfolio before we go and source external opportunities. So I think we've got some work here to do in the short and midterm that could greatly benefit shareholders as a result of what we already own.
I got to commend you because I hadn't really thought about that. Federal actually, even though you guys are night and day as far as market cap size, great peer to compare yourself to, I think. You mentioned AAT, buddies with some of the team there. I'm also thinking of like a Sol Centers for
Yeah.
those that want to go really deep in the weeds, or even Douglas Emmett, some aspects of Douglas Emmett there too. But, the takeaway, as you just kind of stated, is yeah, it's all those companies with an asterisk because again, we're all a little bit different, different market, different subclass. It's very interesting mindset. Um, but look, as REIT investors, when it's all said and done, it's all about the dividend. You can't control your stock price. We talk about the dividend. So for us who runs dividend funds, have investors that focus on the dividend side of the equation, talk to us about dividend coverage and safety.
Yeah, that's a great question. For those who have been following us for a while, we made a very difficult decision to right size the dividend in early 2025. And my very strong view is, and I hope it's the view of most, I trust it is, that the cash dividend should be supported by the cash flows of the properties. And at the time, we had an AFFO that was inclusive of fee income that was not cash, not current cash, as a result of the real estate financing platform. So we made a very difficult decision after a lot of calculation to bring that dividend into check, right, into the right range. And obviously there's a cap and a collar here, right? We want to be totally covered, but we don't want to dip below the taxable, threshold, if you will. So for us, we reset that dividend to 14 cents a quarter. And we're still at 14 cents a quarter. We are covered now. We intend to remain covered. But I think given the pain that that resulted from that, David, in terms of a cut, which none of us want to do, I call it a right sizing because it was actually that we needed to right size the dividend relative to our business. We took a hard look at that too when we ripped the Band-Aid on this transformation to ensure that we could cover that dividend and we could leave it in place while walking through this transformation. So we feel very good about the dividend. We're very confident. I know some investors would say, "Hey, Shawn, when are you going to raise it?" The truth is, given what the company's stock has walked through, we are going to raise it at the right time and in a conservative way, is the answer to the question, David. And I don't see a reason to raise it here in the near term. But as we continue to grow earnings, we will continue to look at it and we will do the appropriate dividend management from a capital allocation standpoint, such that we don't find ourselves in a risk position on a go-forward basis. So I feel very good about the dividend. On a yield basis, obviously, given where the equity trades, it is high. But we're comfortable with the absolute value of it and the cash coverage of it as we sit here. And as I said, as we continue to look for opportunities to kind of close the gap and increase value to the shareholders, we will evaluate and analyze the dividend, but we're going to be conservative about it and in a way that's sustainable to shareholders.
As I was talking to Chelsea about this, as before we were going into it and looking at the questions, I realized I probably have to retire one of these questions that I'm going to ask you and replace it now with something else. So we're going to ask you a two-part question here. The question I usually go with is how do tariffs impact AH Realty Trust and your tenants? But I feel like that tariff story is finally that ship has sailed. So instead of the tariff question, how does AI impact you guys and your tenants?
Sure. We get that a lot. I think the open air retail is really a daily life shopper experience, right? So we're not seeing a lot of chatter about AI in the space as of now. And I think the retail remains healthy. Obviously, retail is hot right now on a relative basis to what we've seen in recent years, which is a good thing for us. And there's a lot of demand out there and a lot of activity from a tenant standpoint, which is great. I think the consumer remains relatively healthy, even in given the macro environment that we're in today, which is good. We get the question mostly about office, and I would answer the question like this. We have seen on renewals and new leases that we've been the beneficiary of, right? The flight to quality, if you will. We've seen the downsizing take effect as they move in. Does that mean that we won't be further impacted? I don't have your crystal ball, as you said earlier. That being said, I think the companies that we're seeing out there, either one, for instance, down in Georgia, play in the space. So we sit on the edge of the Georgia Tech campus there, our office. And I think that asset benefits from the AI business because the engineers and all the software professionals coming out of the school are hired into these companies adjacent to the campus. And there's a nice relationship there in terms of the activity that it allows our asset to experience. Here in Virginia Beach, we have professional services, obviously law firms, and I just mentioned KPMG earlier in the conversation. Those types of folks, we haven't seen an impact there, and candidly, they downsized when they came here, and they're making more efficient use of the space than they have prior. As we think about Baltimore, we'll see. We haven't seen it yet. We obviously moved T. Rowe Price into a 553,000 square foot building. By the way, that building went live last year. They moved in, and so that building took about 2 years to construct. They upsized the building by 100,000 square feet in the process. So to me, people are thinking about what is the new office environment post-COVID. That was even longer ago than tariffs. But also people are thinking about what is, but these are long-term decisions these folks are making, and the credit profile and the type of tenants we have. I don't think I'm sure there will be enhancements. The argument about there may not be as much downsizing as there is increased efficiency. I'm sure that will all shake out. But our view is if you have the trophy assets in the submarket, specifically the ones we sit in, you're the beneficiary of the flight to quality. And I think that includes enhanced company, efficiency and company profitability. And companies still want a place to go to work, regardless of how much AI they're leveraging, or maybe said a better way, AI is leveraging them, right?
And it's interesting because, again, I'm not comparing you to an SL Green or Vornado, but the New York office REIT executives have been extremely transparent, talking about all of the firms, the AI specific firms that have been leasing up the office space from them. Obviously, again, it's difficult to compare San Francisco and New York City to Virginia Beach. I'm not knocking Virginia Beach, but clearly you are seeing signals out there that there is office demand. There is leasing. And I always get pushback from people like, well, the office is dead. I go, no, it's not. Office goes through cycles. This is not the first rodeo. Do you think the Empire State Building is going out of business anytime soon? And I go, if anything, if an office landlord has to reset pricing, if anything, this is my opinion. What do I know? I'm an idiot in Dallas. But as I like to say, if you have to reset the pricing on Will's point, guess what? That means that prospective tenant who's thought to themselves, man, I wish I'd love to be in an office, but I can't afford that office space. Now suddenly you can afford that office space. And oh, by the way, 3 to 5 years down the road, when that lease renewal comes up, guess what? Not like you're going to be cutting their office rent 3 to 5 years down the road. It's going to be going up. So I feel like, that volatility potentially provides the opportunity for a firm to potentially live out the American dream and finally lease that desirable office space that once was not as affordable, now suddenly does become affordable to them.
Yeah, I think, look, we haven't seen the reset yet in our markets, which we're thankful for. And maybe to your point, that scenario plays out. But I think what we should add to that, David, is this kind of bifurcation or differentiation of the office product in general, right? When a certain type of firm wants an office presence to attract clients or whatever they may need to do, they want it to be nice and they want it to be a productive environment for their employees. And to your point, things may ebb and flow, but I think at the end of the day, the properties that are the A properties continue to thrive, and this shakes out. I mean, it's not really different than the 2000s retail kind of experience, right? There was this retail, and all retail was going to be dead because of Amazon and so on and so forth. And by the way, some of that was true. But I think what we see today is that supply was constrained over the next 15 years, and retail demand outstrips the supply in a lot of cases today. And I think you'll see that. I think you'll see that in office once it's differentiated. And I think that's going to take some time, right? This is not a suburban office. This is an ecosystem. And to your point, the office in Manhattan or major other cities is seeing demand from people who need the office space, whether that be someone who is experiencing, to your point, a reset, or someone who actually is creating this technology and needs office space to do it in, right?
You talk about retail in the 2000s. I feel like you could, replace 2000s with COVID. I feel like a lot of people said the exact same thing about retail during COVID that's going away, being replaced by curbside, online pickup, and all of this stuff. And no, companies adapted, they thrived, and they evolved. And I feel like that's what a lot of these companies have been doing. All right. It's amazing how quickly an hour flies by. And we're getting close to the end here. So obviously, if anybody has any questions that they'd like to put in the chat, please feel free. We'll try to get to it. But besides figuring out if you're going to go to Ruth Chris or Legal Seafood for dinner this evening, what keeps you up at night these days?
Yeah, it's an interesting question. I think these days, obviously macro trends are front of mind, right? The macro environment. But I think, if you double click into our business, David, it's the short-term horizon. We talked about this a little bit earlier in terms of capital availability, the short-term horizon of the market in general, right? The long-term capital is not yet back into the REIT space. And we are owning and signing, we're owning long-lived assets, signing long-term leases, but the capital is relatively short in terms of its staying power. And I think, until we get a little more footing broadly in the REIT industry, not just AHRT, but I think until we get back to focus on fundamentals, things will continue to move around. And I think, look, things that keep me up are what's the next shoe to drop, broadly in the macro sense that affects short run valuations of real estate companies who are making long-term decisions to the benefit of the shareholder. And I think that's kind of what keeps me up at night, right? Obviously, we're in a cost of capital business. Capital allocators at their core, right, are REITs. And I think to the extent that the capital stack, or specifically, the investors are moving in and out of these REIT stocks, makes it much more challenging to make decisions with a long horizon. But that's what we'll continue to do. We've committed that to our shareholders. We will be disciplined capital allocators, and we'll look for long-term value creation. And that's what you see us. That's what you see us doing. It's been challenging. I'll be candid. It's been very busy, but good busy because we believe that we're setting foundational elements in place for long-term value creation here at AH Realty Trust.
Here's the easiest softball question for you then, because you just teed yourself up. Why AHRT in 2026 and beyond?
Yeah, I think you have a chance to um, catch us in what you characterized as 2.0, what I'll characterize as our transformation to AH Realty Trust. We, again, if you think about the foundational comment and use a metaphor, we're laying the foundation and coming out of the ground now on what is a sharper focus and removing dilutive activities and business lines from our focus such that we can add value where we do it best, and that is candidly in the commercial space, open air retail, mixed use office environments, and ecosystems that we own. And we're excited about it. Obviously, we've done some things that were challenging, and the market reacted in the way that it did. But I think also we have an opportunity here to continue to build confidence in our team, in our company, and to continue to provide value that maybe others are overlooking.
John, you've given us a lot to digest here over the last hour, and all I can say is it's going to be really fun to watch this story evolve, especially as we hopefully move away from what's going on overseas, as we focus back on internally here, as we see fundamentals continue to improve. As you know, I like to tell people, look, these companies have no control over their stock prices. What they could focus on is the operations, the fundamentals. Are the revenues growing? Are the dividends growing? Is the net income growing? Do the companies keep their, to keep the blinders on and focus on the business's hand? And it seems like that is priority number one, focusing on the business at hand, focusing on the portfolio and ways to add value. So I can't thank you enough for spending an hour sharing your insights with us. I look forward to seeing you here in a couple of weeks in New York City as you could, really observe the live, work, play environment in real time. And, on behalf of the entire Hoya audience, I can't thank you enough for all the wisdom you've shared with us today.
David, thank you for the opportunity. On behalf of the team and the board, we appreciate you giving us the opportunity to tell our story. We're just getting started and we're excited about the future. So thank you for taking the time.